All right. Matt, the mortgage guy here. In today's video, I'm going to tell you some surprising news about interest rates in 2022. I want to get into a forecast done by my good buddy, Barry Habib at MBS Highway. Huge shout out to this guy. This guy's been forecasting, following real estate, following the mortgage industry for 20 plus years. And this guy's spot on. So when I tell you that rates are going to decrease the second half of 22, don't think that I'm crazy, because I'm literally taking advice and information and data from a legend in the mortgage industry, Barry Habib. So I'll jump into it. I'll show you what they've kind of put together as a forecast when it comes to the mortgage market, when it comes to real estate, when it comes to the stock market as well. I'll give my 2 cents, my insight, take it for what it is, for, however you want to interpret it, right? But this is coming from the GOAT himself, Barry Habib. I'll jump into it. Before I do, please consider like, comment, subscribe to the YouTube channel. I highly appreciate it. I'm putting out content as a mortgage broker who's in the business all day, every day, talking to real estate agents, talking to consumers, watching real estate, watching the mortgage market, and then delivering it to you in as simple as fashion that I can. Boots on the ground, right? You're hearing information from me as I get it, right? The conversations I'm having today, not something that gets put on a stat sheet where you're looking at numbers from 3 months ago, what happened in the market 3 months ago. I'm giving you today's information in real time. So let's jump into this 2022 forecast. I found it really interesting. I hope you do too. Let me know in the comments below what you think about it, what your predictions are, if you see it different, what you'd like to add. I'm always up for good conversations, debate. Not everyone's going to have the same viewpoints, right? In the comment section is good for that. All right, market forecast 2022. First and foremost, before we get into 2022, a little recap of 2021. Like I said, this information being brought to you by Barry Habib and MBS Highway. Expected rates to rise the beginning of the year and recover into the fall. What we saw, that was the forecast, right? What we saw, the actuals were that rates rose sharply the first few months of the year. And then in March, they started to recover. And by late summer, they recovered any of the losses they had seen these last couple months, right? Rates have gotten a little bit worse. I think since August, we've been on a steady increase in mortgage interest rates. And then housing, as predicted, strong demand and tight supply. And I think that a lot of people saw like 8-9% home price appreciation. The actuals were well above that, right? 15-18% in some markets, in the 20s, but strong demand and tight supply. COVID caused supply chain issues and labor shortages. And that, forecast, although it was pretty bullish, right, was still very well below what we ended up coming in on with double-digit home price appreciation in 2021. All right, on to 2022. I'm not going to go through every single line of this because I think that might take 30 minutes, but the Fed is going to play a major role in 2022. I think we all know that. Tapering and rate hikes and all these things that we've talked about. It's going to not only impact mortgage rates, it's going to impact housing, it's going to impact jobs, it's going to impact equity markets. And, the folks who actually make up the Fed, the voting members, right, that changes every year. And when it says the 2022 composition will be less accommodative than 2021, that means more aggressively pushing up interest rates, right? Accommodative is like they've got this low interest rate environment where they're accommodative. They're going to be more aggressive with the tick up of interest rates to fight inflation. That's the main focus right now, right? And I think that we've seen Jerome Powell come out and say, listen, guys, my bad, not transitory. We need to raise interest rates to fight inflation, because that latest number that came out at 6.8% might not even capture what true inflation is right now. It might even be over 7%. But for rough numbers, let's call it 7%. in this findings, right, we talk about negative stock market reaction could cause the Fed to kind of like throttle back if they see the stock market like taking a humongous dump and they get any flack for that. They might, take their foot off the gas a little bit, but they have to raise interest rates to fight inflation. They realize inflation's a problem. They've said it, right? So you're going to see in this report really cool history to help us kind of figure out what these Fed actions are going to do, how they're going to influence the markets. So let's just look back in history, and I'll skim through this. Back in 1970s, when Arthur Burns was the Fed chair, inflation went from 78 to 80, like from 7% to 14%. And this is funny to look back and say that, he was steadfast that inflation was transient. I don't know if you ever heard that. Transitory, transient, same word, right? And so with that increased inflation, we saw mortgage rates go from 12% to 18%. 1980, Paul Volcker, the Fed funds rate that's now at 0, it was at 11%. And it got hiked up all the way to 20%. Can you imagine, right? Like, it's hard to even imagine that right now. And inflation dropped from 14% to below 5% with that hike up of the Fed funds rate. And because inflation dropped, mortgage rates that were up to 18%. I know my parents bought a house in early 1980s when I was just a youngster, and rates were in the teens, right? But they went from 18% down towards 12. Lucky folks, right? They were getting, they were able to refinance from their 18 to the 16%, then from the 16% down to 13% or 12%. They felt pretty lucky in the early 80s. The consequences of all this, mortgage rates dropping and taming inflation, was that the S&P 500, the stock market, tanked by 30%. And the tightening monetary policy basically forced the U.S. into a recession. Then we've got Alan Greenspan, which people are probably more familiar with him. It's more recent, late 90s. Inflation doubled from 1.75 to 3.5%. The higher inflation caused mortgage rates to go from 7 to about 8.5. He took action and hiked the Fed funds rate from 1.75. By 1.75. I'm sorry. So the Fed funds rate was 4.75. He, hiked it up 1.75% to 6.5 in a year. Took pretty drastic action that caused inflation to go from 3.5 down to 1, and mortgage rates dropped 3%. Which we're seeing a pattern, right? If you can tame inflation, rates are going to come down. So inflation goes from 3.5 to 1. Mortgage rates go from 8.5 to 5.5, sparking a huge refinance boom. During this one, similar type deal where the mortgage stock market fell by 50% from the spring to the fall of 2000, and then the U.S. entered a recession in 2001. So let's take a look at all of this. That's what. Oh no, we got to look at our boy Jerome Powell first. Then we'll take a look at all those and see the similarities and see what we can deduct might happen under our boy Jerome Powell. 2021 inflation increased from 1.75 to 7. And the latest CPI number is 6.8. We'll call it 7. Rough numbers. He said transitory. Sound a lot like transient, like 1970s. Mortgage rates have gone from mid 2s to 3.25, 3.375, and that's today's rate about where we're at, right? The Fed is currently tapering their purchase of mortgage-backed securities. They've talked about this. Once they're done with that taper, they're going to start hiking interest rates, hiking the Fed funds rate. And they talked about 3 rate hikes in 2022 and 3 rate hikes in 2023. Know that inflation, can still rise. And I think that like the numbers we see in January and February of this year, we expect to see them continue to increase. So we're not done, right? It might go 7.5. It might go 8%. If the Fed can tame inflation we've seen from these past slides, right, that taming inflation, bringing inflation down from wherever it ends up being 7.5, 8%, bringing that down maybe to 2 or 3% target, should cause mortgage rates to drop, right? And let's just look at all of this, to see if we can spot a pattern. Whoopsie dazer. Burns, Volkner, right? Inflation goes from 7 to 14. Rates go up. The Fed funds rate gets hiked by 9%. Inflation comes down, and mortgage rates come down, right? Same thing happened with Greenspan. Inflation had gone up, mortgage rates had gone up, so he hikes up the Fed funds rate. This is ticking up the price at which banks can borrow from each other. It causes inflation to be tamed, inflation to come down, and mortgage rates come down. Both of those ended with stock market down and recession. Jerome Powell, we see them targeting 2% inflation and calling the inflation we are seeing transitory. Not transitory. You finally admitted to it. We've got 7% inflation. Mortgage rates have gone up because of it. So the Fed's funds rate, which is currently at 0, once they get done tapering their purchase of mortgage-backed securities, they've talked about 3 rate hikes in 2022. And whether that's a quarter and a half, 3 quarters, 2 halves and a quarter, whatever that ends up being, let's call it 0 to 1% in 2022 is about what we should expect. Inflation should drop. It should come down. What's going to happen when that happens? Mortgage rates should decline. So when we talk about the fact that we're definitely going to see mortgage rates increase, for sure. As the Fed slows down their purchase of mortgage-backed securities, they increase the Fed funds rate, and then the mortgage-backed securities that are on their balance sheet, as they start to shed those, we should see inflation go down. We should see interest rates. I'm sorry. This is happening. Rates are going up, right? Then as the Fed funds rate gets ticked up, inflation is going to come down and mortgage rates are going to come down. So if you were a betting man and if you were following the logic in this, you would say the first half of the year, we might see rates go up to 3.75, 4%. The second half of the year, as inflation comes down, we might see rates tick back down near 3%. And obviously this is one of those things where there's wild cards, right? We can't predict everything, right? If it was that easy, then I'd be rich and retired along with a bunch of my friends. So wild cards. COVID plays a major influence on monetary policy. And, Jerome Powell's talked about it when there's new strains, when there's new risk, when there's more uncertainty, they tend to not be aggressive with anything that they're doing, changing monetary policy, because they don't want to shake things up when the economy is on unstable footing. Once the economy is on stable footing, that's when they make, their more aggressive changes to monetary policy. So any major surprise in COVID could change the outlook dramatically if, COVID subsides, if there's no new outbreaks or new strands that folks are worried about and there's more certainty in the market, they do what they're going to do with monetary policy. This outlook, could end up being something that rings true. Additional stimulus, more money in the economy. We know that stimulates the stock market. That could be something that makes interest rates rise further. If the economy is doing great and they're ticking up the Fed funds rate and everything's fine, that's going to make it harder to corral inflation. That's going to cause them to do more stuff to monetary policy, tick up the Fed funds rate even more to tame inflation, right? And the runoff of the Fed's balance sheet, like we talked about, the first step, they're tapering their purchase of mortgage-backed securities. Once they're done with that taper, they've said it already in past meetings, they're going to hike that Fed funds rate. They're currently reinvesting, right? Even though they're tapering their current purchases, when they're not letting stuff fall off their balance sheet. So that's keeping rates low. If and when the Fed stops those reinvestments, mortgage rates could move even higher than previously thought, right? So there could be some things that happen where we're saying we might be at 3.5 or 3.75 by middle of the year. It wouldn't be that surprising if we got to 4 or 4.25 based on how all these things play out, right? So stock market forecast, as we've seen, it looks like if these things hold true, if the past is any indication of the future, we could see, with all these things, monetary policy things that are being done by the Fed to tame inflation happen, it could have a negative impact on the stock market, right? It could cause, contraction in the stock market. The forecast is about a 10% decline in major indices in 2022. It could be worse, truth be told. And, if you want me to put in some of my flavor, a lot of this stuff where it shows, overvalued, like the price to earnings ratio on a lot of companies seems very high. I'm not a person who's, not exposed at all to the stock market, but I'm very aware that it carries risk. And I think right now it carries more risk than normal. Okay, interest rate forecast, that's what everybody wants to know on a mortgage channel. Mortgage rates increasing during the first part of the year. And I've been saying this for a while. I've been warning people, if you like it, lock it. We've seen literally since August, right, a steady increase in mortgage rates to where we're probably at, 3.25. I think the slides here said 3.375. Being at 3.75, 3.875, 4% in the next 3 or 4 months is not something that would surprise me. Seeing interest rates on a 30-year fixed with a 4 by the middle of the year would certainly not surprise me. If things hold true, Fed takes action like we've seen and inflation gets under control, we're going to see a decline during the second half of 2022. And, if I were to add my personal opinion, I think that we might be underestimating how high they can go. And when it says rates rise towards 3.75, I think we might go even higher. And what that's going to mean if there's a decline is that we're declining from a higher level. So maybe they get to 4, they get to 4.25, and then they decline, but they only decline down to 3.5 or 3.25 versus the 3% we see here. So that's, I guess, my 2 cents on that. What that means strategically for me as a mortgage broker, and this lines up perfectly with how we run our business anyway, is to be strategic about your mortgage. You want to set up a loan with less upfront fees. You're not going to pay points, in March or April to buy down your rate to 3.25 when you might be able to get 3.25 in October or November for free, right? Don't set yourself up in a mortgage where you've got to have this mortgage for 5 or 6 years to break even on the points being paid, only to refinance out of it 6 months later. That's just something that you want to be aware of. And I think more often than not, when you do the break-even analysis, paying points isn't always a great idea, right? People never stay in a mortgage as long as they think they will. So beware of that. Housing forecast. Housing's going to remain strong. I've said this in near every video I've done. I've tried, I promise you, I've watched stuff. I've tried to be open-minded. I've listened to, the folks, the ones that are really crash. They literally say that every year. 2014, 15, 16, 17, 18, 19, and 20, and 21, and 22. And they'll say it again in 23. There's just too much stuff that is working against there being any sort of crash, right? Like demand might be slightly softer because interest rates are a little bit higher. There might not be as many people moving. And so, supply is going to remain fairly tight, right? Like if rates go up and you've got a 2.75, I've said this in a past video, people aren't going to be jumping to go upgrade their house and get into a 3.75, right? There's not going to be any mass production of houses. It's just impossible to do. So, you're going to still see home price appreciation in 2022 is my guess. I don't think it says it on this slide, but I think that the guesstimates are 6 to 8% appreciation. And, alongside that, rents are going to continue to rise. Increases in rents have been, across the board, across the U.S., 5 to 10%. In some markets, it's above 10%, right? So people who are on the fence between buying and renting are going to have, issues on the rent side as well, right? It's not like, buying's more expensive and rates are higher, so maybe I won't buy, because rents are going to be higher right alongside that. So went a little bit longer than I expected. Hopefully this was valuable. Let me know any feedback, any comments, positive, negative, what you think, what your plans are for 2022. If you are looking to get pre-approved, if you're looking to refinance, anything that you have related to mortgage, please reach out to us. greatmortgagebroker.com. Fill out the form. Let us know where you're at, where we can help, what questions you have. We are more than happy to help. We're going to help a lot of homeowners in 2022. Hope you're one of them. Thanks for watching. I appreciate you. And until next time, we gonna see.